1 week ago, a gallon of gasoline in the United States cost under $3. Today, it is $3.41. The average 30-year mortgage, which had just fallen below 6% for the first time since 2022, is back above 6%. The Federal Reserve, which the administration has been pressuring to cut interest rates, has publicly signaled it cannot. And the American economy shed 92,000 jobs in February against an expectation of a gain. All of this happened in 1 week, and all of it traces back to the same decision. That is not a political observation. That is what the data shows as of the week this video was recorded. Here's the part that makes this structurally remarkable. On February 21st, 2026, 1 week before Operation Epic Fury began, Donald Trump stood on the floor of a joint session of Congress and named 3 specific numbers as proof that his economic program was working. Gasoline below $2.30 in most states, consumer price inflation at a 5-year low, the S&P 500 up 13% over 12 months. These were not vague claims. They were explicit, public barometers: gas prices, consumer prices, the stock market. The administration said, in front of Congress and the country, this is how you measure whether we are succeeding. 8 days later, every single one of those metrics began moving in the wrong direction simultaneously. Not one, not two. Every metric, at once. If unpacking the mechanics behind major economic decisions is why you are here, hit subscribe now and drop a comment telling me which of the 4 mechanisms concerns you most. I read everyone. This is not a story about the war. This is a story about 4 economic mechanisms that turned the president's own economic scorecard against him at exactly the same time. And once you understand how each mechanism works, you will understand why this is not just a temporary price shock. It is a structural trap, one the White House built for itself. Before we go any further, all figures in this video have been cross-referenced across 3 independent sources. Numbers you will hear from the Bureau of Labor Statistics, from Goldman Sachs Research, and from AAA Motor Club data. This is not speculation. This is a breakdown of the mechanism. By the end of this video, you will understand exactly how 4 specific financial channels connect a military strike in the Persian Gulf to your gas station, your mortgage payment, and the Federal Reserve's ability to cut interest rates. I am not a financial advisor, but the mechanics here are concrete, and they are worth understanding. Trump told lawmakers he had seen a gallon of gas for $1.85 in Iowa, the lowest in 4 years, he said. CPI was falling, the stock market was up, and the housing market was finally showing signs of life as mortgage rates moved lower. These were the conditions his administration had named as its economic success story. 8 days after that speech, Operation Epic Fury began. I want to be clear about something before we go further. This is not about whether striking Iran was the right decision. That is a political and strategic debate far beyond the scope of this analysis. This is about economics, about 4 mechanisms that now operate independently of intention, ideology, or the eventual outcome of the conflict. The market does not care about motives. It cares about flows. The Strait of Hormuz is 21 miles wide at its narrowest point, less than the distance from Midtown Manhattan to JFK Airport. Through that corridor passes roughly 20% of the world's daily oil supply, approximately 20 million barrels every 24 hours. Iran controls the northern coastline of that strait. When the United States and Israel launched strikes on Iran, Iran declared the strait a closed military zone. Tanker transits, which had averaged 24 vessels per day in January, dropped to 4 on the first Sunday of the conflict. 3 of those 4 were Iran-flagged. Major shipping lines, including Maersk and Hapag-Lloyd, suspended Gulf transits entirely and began rerouting vessels around Africa, adding weeks and thousands of dollars in cost to every shipment. Qatar halted liquefied natural gas production at its 2 main facilities after infrastructure attacks, removing roughly 20% of global LNG supply from the market in one move. That number means the consequences of closure are never proportional to the corridor's physical size. Before the strikes, West Texas Intermediate crude oil had been consolidating near $65 a barrel for most of February. That stability had been one of the quiet engines behind the low gas prices Trump was citing. Within 8 days of Epic Fury, WTI settled above $90 a barrel, a 36% increase in 1 week. Brent, the international benchmark, reached nearly $93. Think about what that means for everything downstream. Mechanism 1 is the oil shock. And here is why what happened at the gas pump was not the story. It was the symptom. When crude oil prices rise sharply, they do not stay in the energy sector. Oil is not just what you put in your car. It is the foundational input for plastics, fertilizers, chemicals, air travel, shipping, and industrial manufacturing. Every truck that moves every product in every supply chain runs on diesel. When crude rises 36% in a week, the price increase ripples outward through the entire cost structure of the economy, and it does so faster than almost any other commodity shock. The pipeline from crude barrel to the gas pump can operate in under 72 hours. The evidence arrived at American gas stations within days. Before the strikes, the national average for a gallon of regular gasoline was under $3. According to AAA, by March 7th, that average had reached $3.41, a 43-cent increase in 1 week. The AAA noted it was the largest similar weekly jump since March of 2022, when Russia invaded Ukraine. Diesel reached $4.51 per gallon, up from $3.76 before the conflict. Think about what that means at every pump in the country. A 15-gallon fill-up at the pre-war price cost roughly $45. The same fill-up at $3.41 costs $51.15. That is $6 more every time you pump, before diesel, before the price of every product that moved in a truck. That number does not stay at the gas station. It travels with every load on every truck in the country. Here is what this looks like in practice. Take a long-haul trucker running the Chicago to Dallas corridor. A standard big rig diesel tank holds about 150 gallons. At $3.76 per gallon before the war, a full fill-up cost about $564. At $4.51 by March 7th, that same fill-up cost $677. That is $113 more per fill-up. On a round trip of roughly 1,900 miles, a big rig burns through about 2 full tanks. The war added approximately $225 to a single haul. The driver did not make a single different decision. The war added it. And that arithmetic runs 24 hours a day across every freight truck in the country. The cost does not stay with the driver. It travels with every load they carry. To put the Hormuz choke point in physical terms, 21 miles. You could drive it in under 20 minutes. A channel smaller than most American cities is the bottleneck for roughly $40 trillion of annual global energy trade. The entire fragility of the global oil system rests on a waterway you could walk across in 5 hours. When it closes, the consequences are not proportional to its size. They are proportional to everything that depended on it staying open. According to Goldman Sachs research, published the day after the conflict began, if the oil price gains persist, annual inflation, as measured by the Consumer Price Index, could rise from 2.4% in January to 3% by the end of the year. The bank noted that every sustained $10 per barrel increase in crude adds approximately 0.2 percentage points to annual U.S. inflation. The administration had entered 2026 with CPI trending toward the Federal Reserve's 2% target. That progress is now directly at risk from the administration's own operation. That is not a complication. That is a self-inflicted contradiction. Mechanism 2 is less visible to consumers, but compounds everything else. It is about the dollar, and here is what nobody is talking about in the coverage of the gas price spike. When geopolitical risk spikes, global investors historically seek safety in US dollar-denominated assets. The dollar strengthens. On the surface, a stronger dollar sounds positive. It signals the world still treats US financial instruments as the safest destination for capital during uncertainty. But a stronger dollar is precisely the opposite of what this administration has said it wants for the real economy. The Trump administration has repeatedly signaled a preference for a weaker dollar, not because weakness is inherently desirable, but because a weaker dollar makes American manufactured goods cheaper for foreign buyers. It supports the factories, the agricultural exporters, the steel producers. It is one of the transmission mechanisms behind the manufacturing revival that tariff policy was designed to enable. When the dollar strengthens following the strikes, it moves against that agenda. Foreign buyers now pay more to purchase American goods. The competitiveness argument for domestic manufacturing weakens at exactly the moment tariff strategy was designed to strengthen it. The war created a currency dynamic pulling against the trade policy. Two of the administration's economic levers are now working against each other. If the breakdown so far has been useful, share this video with one person who follows economic policy. And hit the like button. It genuinely helps this analysis reach more people. Mechanism 3 connects this war to American family finances in the most direct and measurable way. Before the strikes, the yield on the 10-year U.S. Treasury note had fallen below 4%. That movement mattered enormously in real estate because the 10-year yield is one of the primary anchors for the 30-year fixed mortgage rate. For the first time since 2022, the average 30-year mortgage in the United States had fallen below 6%. According to Freddie Mac, the week before the strikes, that average stood at 5.9 to 8%, below 6%. Economists and housing analysts described it as a key psychological threshold that could help revive a housing market that had been effectively frozen by high rates for 3 years. That threshold mattered more than any single number in the American housing market that week. Within 8 days of epic fury, the 10-year Treasury yield had climbed above 4.1%. Mortgage rates crossed back above 6%. According to Freddie Mac's weekly survey for the period ending March 5th, the average 30-year fixed rate stood at exactly 6%, and the trajectory was upward. One week, it crossed below 6 for the first time since 2022. The next week, it was back above. Read that again. A 3-year milestone in the housing market reversed in under 8 days. On a $400,000 home loan, roughly the median purchase price in many U.S. suburban markets, the difference between a 5.9 to 8% rate and a 6.1 to 5% rate is approximately $69 per month. Over 30 years, that difference totals approximately $24,800 in additional lifetime interest. For a buyer who had been watching that sub-6 reading as a signal to finally enter the market, the war cost them nearly $25,000 in additional lifetime interest before they signed a single document. Now, you might be thinking, can't the Federal Reserve just cut rates and solve this? That would be the straightforward fix. But this is exactly where the answer runs directly into mechanism 4, the one that may be the most consequential of all. Let us step back and take stock. 3 mechanisms are already in motion. The oil shock has pushed gasoline 43 cents higher per gallon, reversing the low energy price narrative Trump delivered at the State of the Union. Treasury yields have risen, pushing mortgage rates back above a threshold they had just crossed for the first time in 3 years. And the dollar has strengthened in ways that undercut manufacturing export competitiveness. 3 of the administration's named economic barometers, gas prices, CPI trajectory, and the conditions for housing market recovery are now moving the wrong way, simultaneously. The 4th mechanism is about why the institution designed to stabilize these conditions cannot move to fix them. Mechanism 4 is the Federal Reserve specifically, the Federal Reserve's inability to cut its way out of this situation. And here is why that matters more than the gas price. When an economy faces an oil shock that pushes inflation higher, the central bank faces a structural constraint that is not a political choice, but a mechanical one. You cannot simultaneously ease monetary conditions and contain an energy-driven inflation spiral. Cutting rates into a supply shock that is pushing prices upward risks anchoring inflation expectations, convincing households and businesses that prices will keep rising, which causes them to behave in ways that make prices keep rising. The Fed learned this lesson in the 1970s. It is not a theory. It is a documented pattern from the last time a major oil shock collided with loose monetary policy. Minneapolis Fed President Neel Kashkari had entered 2026 expecting 1 rate cut for the year. At a Bloomberg event on March 3rd, he indicated that expectation was now in doubt. With the geopolitical events, we need to get a lot more data in, he said. Kashkari had also noted that inflation data before the Iran conflict was running somewhere between 2.5 and 3%, already above the Fed's target. Cleveland Fed President Beth Hammack was more direct. Rate cuts, she said, could be on hold for quite some time. 2 voting members of the Federal Open Market Committee, the committee that actually sets U.S. interest rates publicly, signaling that the oil shock had changed their calculus. By March 6th, interest rate futures markets had repriced accordingly. Traders pushed expectations for the first rate cut of 2026 to July at the earliest. The number of cuts priced for the full year fell to approximately 1.5, down from over 2 before the conflict. If you want to understand the full picture, make sure you are subscribed. Drop a comment below with your take on what the Fed actually does next. This repricing has direct consequences. Higher rates for longer mean higher mortgage rates for longer, higher borrowing costs for businesses for longer, and higher interest payments on the U.S. national debt, which reached $29 trillion during this period for longer. The debt servicing cost of the United States rises with Treasury yields. Every basis point the Fed cannot cut because of the oil shock is additional interest cost to the federal government. The administration had stated it wanted lower rates to reduce the debt burden. The war made lower rates harder to justify. And this is where the story becomes almost structurally ironic. Here is what nobody in the markets fully priced in when Warsh was announced. On January 30th, 2026, Donald Trump publicly announced his nomination of Kevin Warsh to be the next chair of the Federal Reserve. Warsh, a former Fed governor and current Stanford fellow, had come to advocate for rate cuts in 2026, arguing that productivity gains from artificial intelligence would allow the economy to grow without driving inflation, enabling the Fed to lower rates. The nomination was read by markets as a clear signal. The administration wants lower rates and will install leadership aligned with that goal. The formal nomination was transmitted to the Senate on March 4th, 2026, 6 days after the president launched the operation that created the exact inflationary conditions that make rate cuts economically problematic. Think about what that means. The president nominates a rate cut advocate to run the world's most powerful central bank. Within days, he launches a war that creates an oil shock that threatens to push CPI from 2.4% back toward 3%. The incoming Fed chair, whose stated position is in favor of easing, now faces Senate confirmation hearings against a backdrop of rising energy inflation created by his president's own military operation. The monetary goal and the military action are in direct structural conflict. Both belong to the same administration. So where does this leave the Federal Reserve? Coming into the conflict, the Fed was moving toward gradual easing. One cut, maybe two for the year. Then the oil shock hit. Goldman Sachs revised its inflation forecast upward. Two voting members publicly signaled the rate path had changed, and rate futures markets repriced the first cut to July. The administration wants lower rates. Markets wanted lower rates. Then the administration launched a war that made lower rates harder to defend without risking a second inflationary cycle. That is mechanism 4. And it does not resolve itself quickly, so where are we? The oil shock is feeding inflation above the Federal Reserve's target. The dollar has strengthened against the manufacturing export agenda. Mortgage rates crossed back above 6%, and the rate path has been repriced by the same decision that created the inflationary pressure. The jobs data had not yet arrived. On March 6th, the same day rate futures were repricing, the Bureau of Labor Statistics released its February employment report. The real reason the jobs number mattered so much was not the headline figure alone, it was what the revisions underneath it revealed. The headline number was negative 92,000. The United States economy shed 92,000 non-farm payroll jobs in February. The consensus estimate had been a gain of approximately 60,000. The gap between expectation and reality, 152,000 jobs in a single month. That number alone would have reset the economic conversation for the week. But underneath it, the revisions were still coming. The unemployment rate ticked up to 4.4% from 4.3% in January. But the headline number was not the worst of it. The revisions compounded the picture. December's original employment figure, reported as a gain of 48,000, was revised to a loss of 17,000. A swing of 65,000 jobs that the government said existed and did not. January was trimmed by a further 4,000. Combined, those revisions meant the labor market had entered February already 69,000 jobs lighter than previously understood. Layer the February loss on top of those revisions, and the cumulative gap over 2 months was 161,000 jobs below where official data had suggested. According to the Bureau of Labor Statistics, federal government employment has now declined by 330,000 jobs, roughly 11% of the total federal workforce. Since October 2024, the labor market was already under pressure. The oil shock arrived on top of it. Let us now bring the 4 mechanisms together, because individually each is a story. Together, they form something more structured. Mechanism. 1 creates an oil shock that pushes gasoline and diesel prices sharply higher, adding directly to consumer prices and reversing the low energy cost argument the administration had been building its economic identity around. Goldman Sachs projects CPI could rise from 2.4% to 3% if current oil price levels hold, eliminating the progress toward the Fed's 2% target. Mechanism 2 strengthens the dollar through safe haven flows, reducing the price competitiveness of American manufactured exports and pulling against the manufacturing revival that tariff policy was designed to accelerate. 2 levers of the same economic strategy are now working against each other. Mechanism 3 pushes Treasury yields upward as inflation expectations rise. Mortgage rates cross back above the threshold they had just broken for the first time in 3 years, adding tens of thousands of dollars in lifetime interest to every new home loan in America. Mechanism 4 freezes the Federal Reserve. Kashkari said it precisely. If headline inflation is going to be elevated for an extended period of time, coming off of 5 years of elevated inflation, that is a scenario we need to pay close attention to. The Fed is not frozen by politics. It is frozen by arithmetic. And the arithmetic was created by the same administration that wants the Fed to ease. All 4 mechanisms are operating simultaneously, not in sequence, at the same time. on top of a labor market that shed 92,000 jobs in February while everyone was watching the oil price. In plain terms, four things moved in the wrong direction at once. Gas got more expensive. Mortgage rates went back up. The dollar strengthened against the export strategy. The Federal Reserve lost room to cut. Each of these would be a manageable story in isolation. Together, they converge on the same household, the household that was told prices were falling and rates were coming down. The administration's response was to say the disruption would be temporary. If they rise, Trump told Reuters when asked about gas prices. But this is far more important than having gasoline prices go up a little bit. He may be right about the broader strategic stakes. And he may be right that prices retreat when the conflict ends. If the Strait of Hormuz reopens quickly, crude prices could fall back, mortgage rates could ease, and some of these mechanisms could begin to reverse. The duration of the conflict is the critical variable. If this video helped you understand the mechanics behind the headlines, subscribe if you have not already. This is exactly what this channel does. Drop a comment. Which mechanism do you think resolves first, the oil price, the dollar, or the rate path? Share this with someone who wants to understand the economics, not just the politics. But here is what the data shows as of the week this video was recorded. The president named 3 public barometers for economic success. All 3 are moving against him simultaneously. The Federal Reserve cannot cut rates to help because his military operation created conditions that make rate cuts inflationary. His nominee to run the Federal Reserve is a rate cut advocate who now faces Senate confirmation hearings during an oil shock his president created. The labor market shed 92,000 jobs on the same day the oil shock was still building. And the revisions told us the foundation was already weaker than the official data had shown. That is not a forecast. That is a description. 4 mechanisms, each with its own arithmetic, each traceable back to the same decision. Understanding that structure is what allows you to evaluate what comes next, not from ideology, but from the data itself.